What if I told you the most dangerous economic event in decades is already scheduled, and almost no one is talking about it? No crash, no breaking news alert, no panic selling. Just a quiet mechanical process that locks into place next month and changes everything for credit markets, for dollar flows, for asset prices across the board. This isn't speculation. This is already on the calendar. The date is set. The volume is known. And the people who understand what happens when this mechanism triggers are already repositioning. Here's what you need to understand. Every month, the United States Treasury has to roll over massive amounts of maturing debt. Bonds that were issued years ago come due. The government has to pay them back, but it doesn't have the cash, so it issues new bonds to pay off the old ones. This is called refinancing. It happens constantly. It's the engine that keeps sovereign debt functioning. But next month, something different happens. The volume spikes. Not gradually, not predictably. It jumps to a level that hasn't been tested in over a decade, and it's happening at the worst possible moment in the credit cycle. The Treasury has to roll over more than $900 billion in maturing debt in a single 30-day window. That's not a crisis headline. That's a scheduled event. It's been known for months, but the market hasn't priced it in yet because the market doesn't think in terms of flow. It thinks in terms of price. And that's the trap. When you have to refinance nearly $1 trillion in a single month, you're not just managing debt. You're absorbing liquidity from the entire credit system. Every dollar that goes into buying those Treasury bonds is a dollar that can't go into corporate bonds, mortgage-backed securities, equities, commodities, or cash reserves. It gets sucked out of circulation and locked into government paper. And when that happens at scale, the first thing that moves is yield, then spreads, then everything else. Now, let's talk about why this month is different. The Federal Reserve isn't buying anymore. For over a decade, whenever the Treasury needed to issue debt at scale, the Fed was there as the buyer of last resort. Quantitative easing, balance sheet expansion. Whatever you want to call it, the mechanism was simple. The Treasury issued bonds and the Fed created dollars to buy them. That kept yields low. It kept the rollover process smooth. It kept the illusion of infinite capacity alive. But that's over. The Fed is now in quantitative tightening mode. It's shrinking its balance sheet. It's letting bonds mature without replacing them. And that means the Treasury is now fully exposed to the private market. It has to find real buyers with real money to absorb $900 billion in new issuance in 30 days. And those buyers are going to demand higher yields. Here's where it gets worse. The buyers who would normally step in are already overextended. Foreign central banks, especially China and Japan, have been reducing their Treasury holdings for years. Domestic banks are sitting on unrealized losses from the bonds they bought in 2020 and 2021 when yields were near zero. Pension funds and insurance companies are required to hold Treasuries by regulation, but they're also dealing with liquidity stress from rising interest rates and falling asset prices. Hedge funds and money market funds will buy, but only at a price. And that price is higher yield, which means the Treasury has to offer more attractive rates to clear the auction. And when Treasury yields spike, even temporarily, every other borrowing cost in the economy moves with them. Mortgage rates, corporate debt, credit card rates, auto loans. Everything is priced off the risk-free rate, and the risk-free rate is about to move. But the real danger isn't the spike itself, it's what happens after. Because once yields rise to clear this refinancing wave, they don't just fall back down on their own. The market learns a new price. It learns that the Treasury is vulnerable. It learns that auctions can be difficult. And once that information is embedded, the cost of borrowing for the US government becomes structurally higher, permanently higher. And that changes the math on everything. The deficit becomes more expensive to finance. The debt service becomes a larger share of the federal budget. And the feedback loop begins. More debt leads to more interest expense, which leads to more borrowing, which leads to higher yields, which leads to even more interest expense. This is the spiral that sovereign debt crises are made of. Not defaults, not collapses. Just slow, compounding increases in the cost of doing business as a debtor nation. Now think about what that means for asset prices. For the last 15 years, every financial asset has been priced in an environment of artificially suppressed interest rates. Stocks, real estate, private equity, venture capital, all of it. The valuation models assume that the discount rate stays low, that future cash flows are worth more today because borrowing is cheap and the opportunity cost of holding risk assets is minimal. But if the risk-free rate resets higher, those models break. A 10-year Treasury yielding 5% or 6% instead of 3% changes the entire structure of equity valuations. It makes dividend-paying stocks less attractive. It makes growth stocks with no earnings unsustainable. It makes real estate deals that were underwritten at low cap rates completely uneconomic. And it does all of this without a single headline about a crisis. Just math. Just reversion to reality. And here's the part most people miss. This doesn't require a panic. It doesn't require a banking collapse or a recession or a geopolitical shock. It just requires the Treasury to issue debt at scale and the market to demand compensation. That's it. The mechanism is simple. The outcome is mechanical. And it's already scheduled. The auctions are on the calendar. The volumes are published. The only variable is the yield. And the yield is going to clear higher because it has to. There's no other way to absorb this much supply in this short a window without the Fed backstopping it. And the Fed isn't coming. Powell has made that clear. Inflation is still the priority. The balance sheet runoff continues. The Treasury is on its own. Now let's talk about who knows this, because the people who manage large pools of capital are already adjusting. Sovereign wealth funds, pension allocators, fixed income desks at the major banks. They don't wait for the headline. They don't wait for the shock. They look at the maturity schedule. They look at the Fed's balance sheet. They look at foreign reserve flows. And they position accordingly. Some of them are shortening duration. Some of them are moving into floating rate instruments. Some of them are hedging with options on interest rate futures. The point is, they're not surprised. They know the refinancing wave is coming. They know the bid is thin. They know the pressure is building, and they're getting out of the way. But the average investor doesn't see this. The average financial advisor doesn't model for this. The ETF flows don't reflect this. Because the reflexive assumption is that Treasury auctions always clear smoothly, that the US government can always borrow at reasonable rates, that the dollar's reserve status guarantees demand, and all of that has been true for so long that it feels permanent. But it's not a law of nature. It's a function of confidence and liquidity and relative value. And all three of those variables are shifting right now. Confidence is eroding because the deficit is exploding, and there's no political willingness to address it. Liquidity is tightening because the Fed is withdrawing support, and foreign buyers are stepping back. And relative value is changing because other sovereign debt markets are offering competitive yields without the same political dysfunction. So what happens when the auction results come in next month and the yield is higher than expected? Maybe it's 50 basis points higher. Maybe it's 75. The media will say it's a technical move. They'll say it's temporary volatility. They'll say the market is adjusting to new supply dynamics. And all of that will be technically true. But what they won't say is that the cost structure of the US fiscal position just shifted permanently. That the interest expense on $36 trillion of debt just got more expensive. That the deficit just widened even further because the government now has to pay more to borrow the same amount of money. That the debt to GDP ratio just accelerated on a path that has no mathematical solution without inflation or default. They won't say that because it doesn't fit the narrative. The narrative is that US Treasuries are safe, that the dollar is stable, that the system is resilient. And none of that is false, but it's also not the whole picture. Here's the psychology that matters. Once the market sees that Treasury auctions can be difficult, once it sees that yields can spike even when there's no crisis, the perception of risk changes. And in credit markets, perception is everything, because credit is just confidence with a price. When confidence is high, the price is low. When confidence wavers, the price rises. And once the price rises, it attracts a different kind of buyer. Buyers who are trading, not holding. Buyers who are speculating on volatility, not locking in long-term income. And that makes the market thinner, more fragile, more prone to sudden moves, which creates more volatility, which demands higher yields, which makes the debt more expensive, which creates more stress. The loop doesn't break on its own. It has to be broken by policy. And the policy options right now are extremely limited. The Fed can't cut rates meaningfully without reigniting inflation. Congress can't cut spending without triggering political backlash. The Treasury can't stop issuing debt because the deficit is structural. So the only release valve is yield. The market will clear, the debt will refinance, but the cost will be higher. And that cost compounds every month, every quarter, every year, until something forces a reset. And resets don't happen gently. They happen when the math becomes undeniable, when the interest expense crowds out everything else in the budget, when foreign buyers demand higher compensation, when domestic buyers realize they're holding the bag. That's when the headlines arrive. But by then, the damage is done. The outcome was locked in months earlier. When the refinancing wave hit and the yield spiked and nobody noticed because it didn't feel like a crisis, it just felt like a number on a screen. So let's bring this back to what you can see. Next month, watch the auction results. Watch the yield on the 10-year. Watch the spread between treasuries and corporate debt. Watch the dollar index. Watch how gold reacts. Watch how credit-sensitive stocks react. Because those are the signals that tell you whether the market absorbed the supply smoothly or whether it choked. And if it chokes, even slightly, that's your confirmation. That's the moment when the structure shifts. Not with a crash, not with a panic, just with a quiet realization that the capacity to absorb US debt at current prices is not infinite, that the bid is not guaranteed, that the next wave will be even harder, and the wave after that, harder still. This isn't about predicting a date. This is about understanding the mechanism. The Treasury has to refinance. The The Fed isn't helping. The buyers are cautious. The volume is massive. And the yield will clear higher because it has to. That's not a forecast. That's just how markets work. Supply meets demand, price adjusts. And when the price adjusts on the most important asset in the global financial system, everything else adjusts with it. Equities, real estate, commodities, credit spreads, currency flows, all of it moves because the foundation moved. And the foundation is moving next month. The shock isn't coming from nowhere. It's coming from the calendar, from the maturity schedule, from the math. And here's what makes this so dangerous. It's not a shock that arrives with sirens. It's a shock that arrives as a number, a yield that's 70 basis points higher than last month, a failed auction that gets reopened, a coverage ratio that comes in weak. And the market shrugs, because it's not a crisis, it's just data. But the data tells you the game changed, the rules changed, the cost structure changed, and once it changes, it doesn't change back. Not without a policy intervention so large, it creates its own set of problems. Inflation, currency debasement, loss of credibility. There's no free lunch. There's only the choice of which problem you want to deal with. And right now, the choice is being made for you. By the calendar, by the debt maturity schedule, by the mechanics of sovereign refinancing, in a world where the central bank is no longer the buyer of first resort. The people who understand this are already moving, not panicking, not selling everything, just shifting. Reducing duration exposure, increasing cash positions, looking at alternative stores of value, watching the signals, waiting for confirmation. Because they know that when the confirmation comes, it won't feel like a crisis. It'll feel like a reset, a recalibration, a new normal. And the new normal will be more expensive, more volatile, more fragile, and less forgiving of mistakes. The shock hits next month. No headlines required. Just math that doesn't negotiate. So here's the question I want you to think about. If the cost of borrowing for the most powerful government in the world just went up permanently, what does that mean for everything else that's priced off that rate? Drop your answer in the comments. Let's see who's actually paying attention. This is the moment. The math is already locked in. The only question is whether you see it coming.